Think big, know your position, leverage confidence, maximize your options, and then push the boundaries. Were these really the steps that framed the approach that this administration took to try and execute on the impact that tariffs would have on the markets, on businesses globally, and then on the uncertainty that has unfolded and unraveled since the implementation of these tariffs? I want to go through in this video the data that backs up the steps that the art of the deal has tried to form, and then also go through the impact that political bias can have on the decisions that the Federal Reserve will take, which has a massive impact on the way that the markets move, the macro outlook, the bond market, which underpins how much faith people have, investors have in the countries that they are investing in. The bond basically is the IOU that the investor is willing to take in that country. And if they don't want to buy these bonds, they're unwilling to invest in this country. Is the US, the bond market within the US, having a massive impact on what the Federal Reserve needs to do? Finally, the macro outlook and how this impacts Tesla. The difficulty in investing and why sometimes the most painful periods are always the most obvious times to position yourself, but at the same time, it's easier said than done. Let's go. If you get any value from this video, like, subscribe, drop a comment down below, hit the notification bells for future videos. Let's get into it. On April the 4th, the most confusingly calculated tariff percentages were revealed. This led to true market turmoil and uncertainty. Disorientate your opponent. Is that the impact that they had? Definitely. Is that part of art of the deal? Most likely. The first step in art of the deal is to try and think big. And so these tariffs were so ridiculous that they resemble these percentages that are calculated for fictional places like Narnia and Wakanda. So you got these percentages by thinking about the amount of consumption that comes from America and the lack of consumption that comes from Vietnam. And the difference between the sizes of these economies is going to lead to a bigger trade deficit, especially if you are selling to America, where you're going to be able to hit a much bigger consumer base. So the calculation for these tariffs was just completely misleading. Now, if you think about the way the art of the deal is broken down, step one is to think big. America are the biggest economy by 27.7 trillion. They understand their position and their leverage and being able to be that biggest market. And so everyone wants to export to America. So that's a really good start in the negotiations that Trump and the administration were well aware of. Step two is know your position. So if you look at these countries from 1 to 7, these are the top 7 exporters to America. And the percentage that this makes up of their own GDP is very high. However, these same 7 countries, when America exports to them, the percentage that this makes up for the American economy is so much less. So the leverage there in knowing your position is you actually don't benefit that much from the exporting of your goods and your services to these countries, whereas these countries make up a lot of their GDP by exporting to the Americans. The next part is also understanding that this massive impact that has happened within the stock market isn't going to affect the majority of average households within America. The actual percentage that are going to be affected by the impact on the stock market is that top 10%. The bottom 50% of households only have 2.5% of the US wealth, and therefore Trump's administration were well aware of the fact that the economy is not the stock market, and they were willing to take risks in impacting it negatively in order to try and reshore manufacturing through these tariffs and through forcing companies to relocate back to the USA. Number 3 is leverage confidence. How they did this is by bringing the bond yields down, the 2-year, the 10-year, the 30-year. When you bring the bond yields down, you're essentially saying that people want to buy your bond. Your bond is an IOU, so it's debt within that country. So if an investor buys the US debt, which is the bond, they don't require as high an interest rate to have this bond because they're confident in the future of that economy. So when you see the bond yield coming down, like in this chart, this is showing and signaling confidence in the USA. And so investors are going, okay, we don't require as high a yield in order to take on the US debt. So this was a massive part of the plan and the strategy to try and bring the yields down so that more people, more investors are willing to buy US debt. So leverage confidence in the country, in the economy. Number 4 is maximize your options. And so how they did this was trying to weaken the dollar, bringing the value of the dollar down across other currencies, paired with other currencies, is going to lead to exports being cheaper. It makes the US products more competitive because they're cheaper for other countries to buy because the dollar that they're valued in is getting less and less. So again, step 4 of this great art of the deal starting to play off. It's starting to look good. It's starting to look like a success. Everyone's starting to really champion Trump as this chief genius negotiator. Step number 5, push the boundaries. Basically, isolate China. What the 90-day pause that was revealed did, it added levity to the markets. They went soaring the next day. But it was also the fact that it forces other countries to come to the table because they now get to negotiate a lower tariff, reciprocal tariff deal. But then it leads to escalation with just China, forcing them into a box. But when China are forced into a box, they're unlikely to want to lose face. And so that is probably going to lead to escalation, which is exactly what happened. However, the signals of the dollar using value against the Chinese RMB shows that, again, there is communication going on behind closed doors because the signal that the dollar is losing strength and the RMB is losing strength, both these countries benefit from their currency losing value against each other because it makes their exports cheaper. It makes their products more competitive. However, by forcing China into a box, it only led to further escalation, where you have two extremely stubborn leaders who are not willing to lose face, starting to continue to escalate the percentages on these reciprocal tariffs to the point where it feels like there's not going to be an end in sight. The backfiring of the Treasury 30-year yield going up, this is where you see the investor losing confidence in the US debt, losing confidence in the US economy. Because as that yield starts to roar higher, this means that the US have to incentivize investors more to buy their debt. And therefore, the confidence in the US is going down. Now, what happens is when this starts to go up, it forces the Federal Reserve to have to make decisions to step in and help support the US economy. So this is a backfire of the original strategy, which is to try and bring the yields down. Problems arise when your chief commentator and advisor to the executive branch who are making these negotiations is someone like Navarro, who has a nuclear style trade war type approach, where he has this view of Vietnam being a country that can reciprocate the same level of consumption as the US. They make significantly less. They can't match the same amount of consumption as the US economy, as they are significantly smaller and the wealth disparity is significantly greater. Therefore, to try and sell $15 for every $15 that the US sell is very, very difficult, to the point where it's probably impossible, which is not helping the progression of these trade deals. Brad Gernster builds a picture of this zero trade deficit as something that's unlikely to happen. It's going to lead to a trade war, lead to recession, and lead to isolation. More very significant figures start to chime into the space, with Elon Musk commenting on this individual being a retard because his view of Tesla being a company that just assemble cars. Elon's just an assembler of cars, not a manufacturer of cars. And actually, within the US, it's the most American-made vehicle. His style is starting to build real friction. And this is not going to help when you have a united front trying to create these new revolutionary trade deals across the world. A really good point from Jeff Lutz is the trade representatives have to be so competent and the smartest people in the room. They have to know every detail about how products are made, the real cost drivers and the opportunities. They can't be on TV speaking about EVs, for example, but not understanding all of the components and the higher ticket items that are manufactured within the US that wouldn't even incur tariffs in the first place. They have to have all of the information to be able to position themselves and negotiate from a place of strength. This led to CEOs, especially in the tech sector, starting to become extremely uncertain with this approach and starting to create real noise and encourage Trump to start to alleviate these deals, which led to the 90-day pause. I'm going to touch very briefly on politics because the Federal Reserve are heavily influenced by political surveys that swing towards a specific party. And in this case, they use the University of Michigan survey to influence their decisions when it comes to whether they tighten the liquidity in the market or whether they ease the liquidity into the market. So fiscal tightening or quantitative easing. Now, if we get quantitative easing, that's going to inject stimulus into the economy, which is going to lead to lower federal funding rates, which means that money is easier to borrow. And all of these lead to more liquidity in the market. More liquidity in the market leads to risk assets growing as people allocate more, as they feel more confident, as they have more money, they're going to be more willing to take risk. So if you've got a political force acting on an independent organization like the Federal Reserve and Jerome Powell, it can be extremely impactful to what happens next. This chart sums everything up. In 2018, the federal fund rate was 2.33%. And today, it's currently 4.33%. You can see that the five-year forward, which is basically 2 steps into the future. The first 5 years, what the inflation rate is going to look like in the US, and then in another 5 years, so 10 years in total. What are those benchmarks going to look like? Now, if in 2018 it's the same as it is now, but the Fed were more willing to cut the interest rates then than they are now, even though the federal fund rate is a lot higher now, it shows that there is an impact from a political bias that's starting to decide how they change their fiscal policy. You can see that the Democrats who vote on this survey think that 7.9% is the one-year inflation expectations, whereas the Republicans think it's 0.9%. Now, if the University of Michigan survey is going to point heavily towards a Democrat view, then it's unlikely that the Federal Reserve are going to act in favor of the Republicans in this case, even though they should be a politically neutral organization and independent of any influence from any president and any party. But there is still an impact and an influence coming from one side of the aisle. Okay, a quick reflection on the bond market, which is basically when you have debt, you need to service that debt. You need people to buy that debt. And investors only buy the debt if they're confident in the future of the economy of that country. So when the yields go up, it means that the Treasury have to work very hard to tempt people to buy their debt. So when this yield's soaring higher and higher, it's an extremely bad sign and a bad reflection on the current state of the economy. It also then leads to gold going up. And when gold goes up, it shows that we're in extremely uncertain times and people are fleeing towards the safe haven of the hardest money that currently exists. And that also then leads to extreme exodus from private equities, public equities, and the stock market has a massive correction and a massive decline. Want to keep this simple market outlook for the rest of the year. This chart is extremely important. You can see that the volume candle on the S&P 500 is the largest since COVID. So this current correction has led to one of the largest volume days we've ever had in the S&P 500 in the last 5 years. Volume shows that there's real buyers that are coming in to position themselves in these stocks and in these indexes. This is an example of how history can sometimes rhyme. You can see this first drop, Trump suggested it's a good time to buy. And then he's just recently suggested it's a good time to buy after this most recent drop. Interesting indicator that I really like. It's showing that the stock allocation hasn't changed. However, the bull bear sentiment is as low as it's ever been. So there's so much bearishness in the market. However, the actual allocation to the market hasn't changed, even though this survey should suggest that that stock allocation should be dropping off just the same way that the sentiment is. Now, I don't want to complicate things too much, but you can see that in 2011, we had this double low where the first low shows oversold. There's exhaustion in the selling base. But then the second time it goes to those levels, it's sold out, which means that there isn't anything left to sell, which means that that is the true final bottom that can be reached. Well, if you look at the Magnificent Seven as an example, we had on March 28th the first low, and then we had in April the second low, which is higher, which shows potential sold out rather than just oversold. But actually, at this point, the Mag 7 has reached a sold out period where there isn't any sellers left. Not just that it's exhaustion and that there's potential fear in the market, but there is no more sellers left based on this second low. This also impacts the high beta derivative stocks where you have the deviators from the S&P 500 because they're a lot riskier. They move a lot faster, upwards and downwards. And you can see again, they've created a higher low, which means that they might be sold out, not just oversold. Because of the recent announcement of chips and semiconductors and other electronical components being exempt from the tariffs, there's this sentiment shift with investors going long, especially in the tech sector. This is going to impact Tesla. Something that's important to understand with Tesla is that even if there is this encouragement for manufacturing to become localized, Tesla already localized their supply chain in all of their gigafactories in Shanghai, in Berlin, in Germany, in America, across the world. So they have already got a localized supply chain where they can supply cars to the Europeans without incurring tariffs. The higher ticket items they don't make outside of the country that they're located in. So tariffs wouldn't really impact Tesla anyway. I want to get into the fundamentals even more. The Tesla factory, especially the next gen Cybercab line, is the product. That, autonomy, and Optimus are what matter. The Cybercab and Optimus and autonomy is what Tesla are moving towards. So the fundamentals of Tesla, they're not going to need to worry about supply chains and imports from external countries because they're a company that are building within the location that they sell to. So this Cybercab line is going to be made internally and it's going to be shipped internally. It's going to be supplied internally. So they're not going to have to worry about the future tariffs that can come from any more chaotic decisions made by this administration. A few funny pictures, just to add some levity. You have the diversified portfolio and then the Tesla portfolio. And if you're a Tesla investor, you can sometimes become so focused on just having an allocation to this one company that you forget that there are other options out there as well. Looking at the future companies and the business line for Tesla, you've got Optimus in the yellow, and that's going to start to become the main majority of this company. And then the blue, you've got the Cybercabs, the Robotaxi network, the autonomy. Currently, the red, the slightly darker blue, and the green represent the energy business, represent the current auto business, and that represents the services business as well. So you can see that the long-term future of Tesla is moving towards two companies that are going to be completely made within the US market. How could all of this be relevant? Well, I want to attach it to the importance of understanding investing. And if you have a long-term mindset, you can just ignore all this noise because you've got the time to just wait for your investments to mature. The closer that time frame, the more the noise impacts you. The more you need to focus on the signals, the more you need to focus on not letting emotion drive decisions in any circumstance. And a really good quote that is quite profound from Cern Basher reads, "More money is lost in an effort to avoid losing money. It is typical, not the equity market declines, that do long-term damage. It is the cost of the poor emotion-driven decisions we make during them. Be careful." You can see very significant people like Eric Trump suggesting this is a great time to add Ethereum, a well-known cryptocurrency, to your portfolio. And since this tweet, it's gone down 45%. So you've got significant noise out there that can make you feel like you need to make a decision, and actually it's probably not going to be the right decision. You've got Warren Buffett, who's got the largest cash pile, over 300 billion. And he would say, be greedy when others are fearful and be fearful when others are greedy. And you can see that he's still not allocated yet. So even in this most fearful time, you've got the most famous investor still not allocating. And it can make you think, gosh, is this the right time to position or not be positioned? And it can just be confusing and difficult, especially when emotions are playing a part in any of the decisions you make. And Trump did warn us that this was the future that we were going to be looking at anyway. So not too shocked by the absolute turmoil in the current markets. I'll leave this as a potential memory to look back on. So do we have a massive rally on Monday to look forward to? What's the old saying? Never go short into the weekend. Basically, at the moment, anything can happen on the weekend. A Trump tweet can spike the VIX, which is the fear and greed index of the market, and it can lead to decisions going either positively or negatively, but in extreme volatile ways. So really hope you got some value from this video. Really hope you managed to understand the way that the tariffs have been strategically framed, but also the problems that have come from these tariffs, and also understand the potential direction the market could start to take as more certainty starts to fill those gaps of doubt and those voids within the chaotic decisions that have been made by this administration. So thank you very much. Hope you get some value from this video. See you in the next one. Goodbye.